Hello class, this is Dr. Fenton. In this video, we're going to talk about fraudulent financial reporting, or in other words, financial statement fraud. Now as always, please read these chapters in detail. I'm just hitting the highlights in these chapters, so you must read the chapter to really gain a lot of knowledge in this area. So just use this video to hit the high points and then go back through and read a lot of the details yourself. So let's get started. Let me lower my video here. Okay. Chapter 3, Fraudulent Financial Reporting. Now, I'm sure you've heard about the Sarbanes-Oxley Act of 2002. Due to the financial statement frauds that happened, just before that, WorldCom, Enron, and a handful of others, the U.S. government decided to pass this all-encompassing law that really put a lot of control over the accounting profession. So I'm sure you've read about this in your auditing class and other articles, so I'm not going to talk much about this. Let me scroll down a little bit. Now, just to show you how prevalent fraud is out there around the world, it says here in EY's 15th Global Fraud Survey 2018, fraud and corruption have not declined globally in the past 2 years. It seems like it increases every year. In PC's 2018 Global Economic Crime and Fraud Survey, it found that 49%, so almost half of organizations globally, worldwide, have been victims of some kind of fraud, fraud and economic crime, up quite a bit from 2016. In another survey, KPMG, 38% of fraudsters work alone, 62% work in groups. Deloitte's survey, 67% of respondents named cybersecurity as one of the 3 risks that would increase. And we do see that increasing every year, the cybercrime. And finally, PwC's 2020 survey found that 39% of fraud is caused by external perpetrators, 37% by insiders, and 20% by collusion between insiders and outsiders. So fraud is prevalent everywhere in the U.S., worldwide. And so in this chapter, we're going to see the most common activities occurring as to fraud. Now, I thought this, survey was quite interesting. It took a survey of different people within the organization and then looked at the type of fraud that, could be perpetrated and found out, who would be more likely to commit this kind of fraud. So if you're looking at having more flexible product return policies, the head of marketing and sales might do this. They might promise their customers, we'll take it back, we'll have a new or special policy just for you, and so don't worry about buying from us, we will take it back. Just be very flexible about this. When we talk about changing assumptions, and this is for determining valuations and reserves, this is more the in-depth accounting type fraud that could occur. Who would do this? More than likely the CFO, the Chief Financial Officer. Now, what about extending monthly reporting periods? Going back to marketing, head of marketing sales. They want to extend the reporting period into the next month, count those numbers in the month just ending to make sales look better. And you can look at these others, backdating a contract. General counsel, is the lead group in doing this. And so I just thought this was interesting. Look at the rest of this yourself. Next page, let's see what we have. Oh, the Transparency International Corruption Perception Index shows you at the top here the ones least likely to have corruption. So Denmark, New Zealand, Finland, Singapore, and so forth. And then you get down and here are the ones that more likely would have it. Here we have the Financial Secrecy Index. Now, the textbook doesn't say much about this. So what I did, I went to the website. And this website is the Tax Justice Network. And so it shows you in so many words. I have a paragraph highlighted right here. What are secrecy jurisdictions? It's a term we often use as an alternative to the more widely used tax havens. Now, I'm sure you've heard that term, tax havens. And they use secrecy to attract illicit and illegitimate or abusive financial flows. So sort of tax havens. And you can see where they are. In orange here are the ones more prevalent. And look at the U.S. It's on up there quite a bit. In fact, it's second next to the Cayman Islands. Here's the ranking. And so as to secrecy, as to tax havens, illicit, opportunity and so forth, the U.S. is number 2 in the world on this. So that's what the book is showing here. Cayman Islands, then the U.S., Switzerland, Hong Kong, and Singapore, and then Norway, Sweden. They're on the low end of things. They're not as much a tax haven. Next page. Okay, here are like some good test questions. If you're asked about the 3 M's of financial reporting fraud, here they are. Manipulation, and it continues with falsification or alteration of accounting records or supporting documents. Misrepresentation, or intentional omission from the financial statements of events, transactions, or other significant information. And the third one, misapplication, so intentional misapplication of accounting principles related to amounts, classification, manner of presentation, or disclosure. So the 3 M's of financial reporting fraud. Now, one thing about financial reporting fraud, remember, this is at the upper level of things. This is for like the 10Ks and the 10Qs. Maybe someone in the company is trying to make the accounting numbers look better than they really are. And so they are, we're going to see in a few minutes here on other pages, doing all sorts of things to make the numbers look better. In later chapters, we're going to talk about employees within the company, for example, stealing from the company itself. But this is at the upper level. We're trying to fool the investing public, in other words. Next page. All right, so how do we do this? Well, some people will get into fictitious or overstated revenues and assets. And one of these is the bill and hold transaction. This is a typical scheme. And what they will do is they will bill the customer, include that as revenue in this accounting period, and then send the product in the next accounting period. That's a bill and hold. We're going to bill it to you today, hold the product, and send you the product in the next accounting period. But we're going to count that revenue in the current accounting period. So it's not really a sale in the current accounting period. And let's see, next page. Now, fictitious reductions of expenses and liabilities. As you know about the balance sheet and the income statement that relates to it, they're all interrelated. So if you're going to bump up revenues, something else in the balance sheet has to happen. I know you're bumping up revenues in the income statement, but through retained earnings, that comes into the right side of the balance sheet. So if you're bumping up the right side of the balance sheet through inflated profits, increasing retained earnings higher than it should be, something else has to happen. And so usually you're bumping up assets. This also happens when you're trying to lower expenses. That also has the tendency to, well, it does, increase net income. And so you have to do something else in the balance sheet. Usually assets will go up. How does this happen? Well, look at WorldCom, the example down here I have highlighted. It shifted almost $11 billion of line cost expenses into capital accounts. Well, what does that mean? They had expenses. They wanted the numbers in the current period to look better. So think about what an accountant would do. The journal entry, you would increase some type of long-term asset account. I forgot which one they used. Maybe I forgot capital improvements or something like that. But they debited a long-term asset account. They credited an expense account. $11 billion worth of that went on. Expenses went down, net income went up, retained earnings went up, and assets were up to keep everything balanced. And so that's what they do. They lower expenses or they lower liabilities. Do something like that. It has to balance out somewhere. So usually if you're increasing net income, you're also increasing assets. And let's see, I need to go back a page to get to the bottom. Let's see, yeah. Premature revenue recognition. Similar to the bill and hold strategy, you invoice sales that were shipped after the end of the quarter. We're going to invoice you today, this period, but next week, in the next accounting period, the next year or the next quarter, that's where we're going to ship you the items. So we're going to include that as revenue today. Now, in this area of misclassified revenues and assets, this can be a variety of things. The example they give here would be like investments. And you know, we classified investments as trading, held to maturity, or available for sale. And how it's classified then leads to how it should be reported in the financial statements. So trading and available for sale securities are reported at fair market value, and they are adjusted periodically up and down, unrealized gains and losses. And so a company might decide, well, I want to classify this security this period as one of these areas, either trading, held to maturity, or available for sale, because I want to control how I report that. I might not want to report the unrealized loss or the unrealized gain this period. I want to sort of play with the classification. So again, this is in the upper level, the higher levels of accounting classification. And Microsoft had done this. What they had done in their example was they just decided that their accruals, their allowances, and some of the liability accounts, this relates to your professional judgment. You have some leeway here. How quick do you think the depreciation should be written off? How should you accrue like warranty expense? Those type of things. And so sometimes managers or CFOs have the tendency to make things look better than they really should by adjusting their assumptions. And again, very, very typical. The next one, overvalued assets or undervalued expenses and liabilities. Similar to what we've been talking about. Again, warranty obligations and so forth. When you get into that upper level accounting, GAAP gives you that flexibility. You have your own assumptions. Now, they should be reasonable, but some people don't stay within that reasonable range and go one way or the other to control what's reported that period, how it's reported, because usually they want to make the financial statements look as good as possible in the current period, and then they might worry about the later period when they get to it. And omitted or improper disclosures, another one. We don't disclose enough information or the required information. We don't want the investing public to know that there's a certain problem in one of our areas in the business. So the companies might be hiding information. So that's what the omitted or improper disclosure area is talking about. Equity fraud. Again, you're dealing usually with securities here. So what did Enron do? Enron issued $1.2 billion in stock to a company that was related to it. There was some joint ownership in there. And so Enron said, look, we sold some securities, some stock to this other company. We're going to report that as a receivable, bump up the assets. We're going to bump up the equity. The balance sheet looks great. Okay, but they're dealing with a related company, and they're just really having a fake stock sale is what happened. This ties into the related party transactions. If you have another party that's sort of co-owned, or a corporation owns part of another corporation, somehow they collude and they start reporting numbers back and forth to make whichever one they want to look the best. And so this happens quite a bit. So you have to watch out for related party transactions. The rest of this you can read here. And here we get into SAS 99. Now you probably had this in your auditing class. I'm sure you did. And so SAS 99 gives 3 major ways that management overrides controls. You might have all these great internal controls in your business. But if people, a lot of times management, can override those controls, the controls don't do any good. So what managers will do, the first one, record fictitious journal entries. Think about WorldCom. Let's debit a long-term asset account, credit expenses. Okay. In easy entry, some of those entries did not have any, they didn't have any justification and no backup documentation. We talked about biasing assumptions. Let's lower our estimate of bad debts. Let's lower our estimate of warranty cost and so forth. It's our judgment. Will you take that too far? Then the allowance that you should be recording is not adequate. And they alter records. SAS 99 also has 3 ways to overcome the risk of management overriding controls. So again, examine journal entries and other adjustments. Do you have proper documentation? Are they justified? Review accounting estimates for bias, including a retrospective review of significant management estimates. Are you writing off your long-term assets over 10 years or 25 years? Again, maybe a judgment call, but it needs to be a reasonable judgment. Evaluating business rationale for significant unusual transactions. Why did this transaction occur? Does it make business sense? Was it just made up? Okay. So EY's 11th Global Fraud Survey provides these mechanisms to help prevent fraud involving management. Stronger internal controls, more robust segregation of duties, stronger compliance, and you can read the others yourself. Okay, let's go a couple of pages and let's see what we have. Now, let's talk about internal versus external fraud. The first 2 columns here are internal, employee or management. So this would be lower level employees or upper level management fraud. So stock theft, this is usually like inventory stock. Misappropriation of cash and assets, and you can see the others, even petty cash. Management, lapping, expense accounts, false financial statements, really what the chapter is all about, kickbacks and so forth. Now, external fraud, who is on the outside trying to commit fraud against our company? It could be check forgery, false insurance claims, credit card fraud, and you can see the others. I do want you to know about the fraud pyramid. Make sure you can see this up a little bit more. When these 3 are present, these 3 items, then there is a higher likelihood of fraud. Someone is feeling pressure to commit fraud. Someone's feeling pressure because they need money. Maybe they have a drug habit. Maybe they have a gambling habit. They've just gotten so far in debt. They feel pressure. They need quick financial relief. Then they have rationalization. They think, I'm working for this company. I should be paid more. They're not paying me enough. I think it's going to be okay. I'm just stealing a little bit today. I'll pay it back later. They're trying to rationalize why it's okay to take from the company. So they have the pressure. They need money. They're reasoning out in their mind, it's okay for now. Either they owe it to me or I'll pay it back later. And then the third one, if the opportunity arises, then someone might commit fraud. They finally see, I have access to the cash, to the inventory. I think I can cover it up. Put these 3 together. This is the fraud pyramid. And fraud, of course, not guaranteed, but there's a higher likelihood of it occurring. Let's add to this right here with the fraud diamond. You see the first 3 that we had in the fraud pyramid. The 4th one they added was capacity. Does that person have the knowledge, the ability, the experience to commit that fraud and then cover it up? Okay, so I do want you to know this one also. I'm not too worried about the fraud pentagon. They add a couple more here. Employee disenfranchisement, personal greed. I do want you to know the fraud pyramid, and then add 1 more item, capacity, and you have the fraud diamond. Okay, so let's jump ahead here, see what we have coming up. Keep going. Again, I want you to read through this. I think I have a few more items highlighted. Let's see, we're on page 24. Yes, down here. Okay. Internal controls. Again, in your auditing class, you've probably talked about these coastal controls. And what internal control is hopefully doing is helping with the effectiveness and the efficiency of operations, the reliability of financial reporting, and compliance with applicable laws and regulations. That's what your internal controls are designed to do. So you should know these three items here. We have three major types of controls that I'd like for you to know: preventative, detective, and corrective. And you can read through figure 3.4 yourself to see what we're talking about in each of these areas. Here's the first one, and here are the other two, detective and corrective. So read through that. And let's see, page 27, yes, right here. And just white-collar crime. Who would commit white-collar crime? You look through the bullet points here, a lot of people. It's possible. You find that person who's married, goes to church, educated beyond high school, no previous arrest records, just about any age. So in other words, anybody could commit fraud. You have that pressure. You have that rationalization. You have the opportunity. It's a higher likelihood, that person would commit fraud. Let's jump to page 31, I believe. Here's 30 and then 31. One last page here. What do you look for in fraud? What do you look for? Early warning signs. Cash flows are not correlated with earnings. Personally, I think the statement of cash flows is probably the most important statement of the four regular financial statements. I know income statement, everyone knows that and looks at it. Balance sheet, maybe. But cash flows are cash flows. That shows you where your cash came from, where it's going. If your cash flows, especially from the operating area, are not matching that same trend in net income, could be a problem. If your income is going up, but cash flows from operations is going down, you ought to look at that very, very closely. Same thing comparing the second point, receivables not correlated with revenues. In general, if your revenues are going up, your receivables should be going up. Okay? Now, if you have receivables far exceeding revenues, you might want to look at that. Why are the receivables so high? Okay? Or vice versa. Why are the revenues so high when receivables are not so high? And look at the others. Allowance for uncollectible accounts are not correlated with receivables. So if you have receivables increasing, the allowance for bad debts staying the same or decreasing, that seems unusual. Again, none of these areas are guaranteeing fraud exists, but these are areas where you need to look closer if you see these things happening. So you can read the others yourself. Now that was it for this chapter, just a quick run through of this. So again, read the chapter in detail, and as always, good luck with your studies.